Welcome back, everyone, to Vox Markets. My name is Paul Hill, and I'm delighted today to have with me UK legendary fund manager, Gervais Williams of Premier Miton. Morning, Gervais.
Hello there. What an introduction. I hope I live up to it.
Well, big congrats to start with on this year-to-date results. I saw from TrustNet this morning, after a couple of lean years, your two small cap portfolios, which say the unit trust is the number one out of 51 this year, up 37% compared to the aim, which is flat. And similarly, the unit trust, the Microcap unit trust, is the second out of 23. So, can you just quickly walk us through what's happened this year? It seems like you've had rocket boosters underneath the portfolio from COVID. It's been an inverse correlation.
Yeah, nobody knew COVID was coming, and whilst that's helped some small companies, it's not been the main driver. The main driver has been actually last year when the markets were rising. A lot of the smaller quoted companies were under real pressure because people were really anxious about what the government was doing and whether there would be this kind of Brexit or that kind of Brexit. And so there was a real uncertainty. And then you overlay that, the Woodford and the unquoted companies. We don't have any unquoted, but it upset people. It meant that actually a lot of our share prices the companies were doing perfectly well, but the share prices are going down. And so what's actually happened this year is that we've hardly changed the portfolio, but actually that there was so much value in the stocks. They've got a better hearing this year.
So effectively hidden value coming to the fore. I saw there's a couple of sort of areas that you seem to be bigger areas. The spread betters you positioned very nicely for it to get the boost of the obviously online or stay-at-home trade, and likewise you've got some of the miners as well. And then there was one in particular, Avacta, which is the biggest now position, has just gone up 800%. So just on those, can you just quickly talk through sort of like some of the success stories?
Yeah, the main thing is that we quite like holdings which are not necessarily correlated with economic growth. We've got quite a lot of holdings which are naturally affected by economic growth. So if you do get companies which are less correlated or negatively correlated with economic growth, then that leads it to a steadier return. Spread betters are a good example of that. They were very overlooked a year ago because they had had some changes with the regulator. That had left them in a strong position. They would have recovered nicely. As it happens, they recovered even better than expected as a result of COVID and the extra trades. And the same thing is with gold. Avacta, again, they've been crawling over broken glass for years. Brilliant investment, brilliant potential long term. And obviously what's happened is that the upside was there anyway, but with COVID and the testing, they've got more immediate upside, and that's driven the share price.
Yeah, and sort of with this, the drug and the diagnostic sides of Avacta, it's now worth a market cap of about 400 million after doing I think it was a 48 million pound placing earlier in the year. But sales of 5 million. However, the runway, according to its broker FinCap, is that it's got sort of like huge potential royalties of sort of $600 million, which you can see. How do you value that? How do you actually, to compare the price with the value? Because when it comes to sort of like selling something that's gone parabolic in such a short period, it must be tempting, but equally you don't want to lose a long-term winner that has just really started its journey.
Yes, we have taken some profits along the way. So not surprisingly, the holding became very substantial relative to others. And so you can take some profits from that point of view. The underlying feature is the therapeutics, the medical side of the business probably is worth something like this market cap, probably a bit more than this already. So all of the extra testing stuff is on top. It's hard to value it, as you say, until they get the sales. They're quite close to getting sales, so we hope. They do get sales, then they could be very, very substantial. What we need isn't so much vaccines. What we really need more than anything else is we need a disposable test you can take before you get on an aeroplane, before you go to a football match, before you go and see your granny in the nursing home. You need to know you're not taking in the disease. And once you get to that, there's vast demand, and that's why Avacta hopefully is well placed for the future.
Yeah, I saw actually this morning that Abbott Labs have also sort of like just launched or they're trying to get FDA approval on a 5-minute one, but that's great for the future. Is there anything else in the portfolio that looks sort of significantly undervalued, that's got world-beating technology that could potentially have a catalyst, a bit like and another Avacta? I saw you had some really quite interesting stocks. Kromek, for instance, the basically CZT detection, and then Corero as well, which has a big partnership with, I think it's Juniper, that does cybercrime and denial of service equipment and software and stuff. So anything else in there which is almost like a Avacta-like that investors might want to put the slider all over?
Well, I mean, what you do see is that you get some very small companies, and whilst they're small in market cap, they're still world leaders in their own industries. Avacta was a good example. Market cap of, just 20 or 30 million last year, with a world leading position, which obviously changed with COVID. Again, Kromek, it has world leading position potentially. With our Corero, we would argue that. More recently, perhaps you've seen something like Simec Atlantis, which is a company which is involved in helping using renewables to generate energy. Again, we would argue one of the world leading positions. Again, the share price is very depressed, and only in the last few weeks has started to rise. So, a lot of these companies have hidden option value. And if the option value comes right, you don't just make 25%. You can make 2 or 3 times your money, sometimes a lot more than that. And so, yes, we'd like to think most of the holdings have that kind of option built in with them.
Okay. And then what sort of like returns are you targeting? I did see in the actual literature for the small cap funds, it said it wanted to make long-term returns, which didn't really tell me a great deal. But I mean, most fund managers are looking to sort of like, double the money over sort of 5-year period, 15% IRRs. Are you targeting those type of returns? I mean, I know over the very, very long term, over your 30-year career, you've taken a £4 million sort of like fund to it's much bigger. So you've done really well. But what sort of like returns would investors sort of should think about those two trusts?
I think actually it's quite interesting as a question, because I think people have got used to making 5 to 10% a year, sometimes 15. I think actually long-term investment returns on the stock market shouldn't be much more than inflation. I think globalization has distorted the market, and I think we've got very used to making lots of money relative to very low inflation. I think going forward, unfortunately, I think we're going to step back to that period. I think a lot of this debt and the dividend cuts, which we've had over recent years, have actually really underlined just how perhaps the momentum of markets has got a bit ahead of the actual fundamentals. So coming back to it, ultimately, I'd love to deliver for my clients a return well above inflation, compounded over time. The whole thing about small micro is that they can compound around 6% more over the last sort of 50 years. They've been compounding at about 6% more than the main market. On top of that, I'd like to add a value. I think actually if you buy overlooked stocks, you get even more upside. If you just invested in overlooked stocks at the smallest side of the UK market, since 1955, that has been compounding at 90% per year. Obviously, we haven't delivered 19% a year, but it'd be very nice to be in that sector with a tail behind us. The wind hasn't been there for ages. We're now beginning to see a little bit of wind coming behind us. There's plenty of upside in these stocks over the long term.
And how do you sort of construct your portfolio to sort of achieve that, as in such that you have a number of sort of like, moonshot plays, a bit like Avacta, significantly undervalued, needs a couple of triggers with world-leading technology, does really well. But presumably you have a sort of like a lot of sort of like, which they call in the cricket game, you go for your singles, you go for your doubles, and you might occasionally hit a 6. How do you actually, what proportions, how do you view that sort of like balancing the technology and the higher growth and the perhaps more speculative areas with the sort of like your tried and trusted, which is solid businesses generating dividends, already generating income, and it's a less sort of like diverse sort of risk perspective?
No, I mean, actually the process is universal for Avacta, for some of the other holdings. It's all about, if we put our clients' cash into something, when is the cash payback coming? How substantial is that cash payback? It's just absolutely, that's the cornerstone. So Avacta, for example, had been investing for years. It hadn't got the credit, but it had been, and the cash payback was getting quite close. It would have been quite substantial in the next couple of years anyway. Of course, it's accelerated with the testing, which we didn't know about at that stage. So you can get lucky. All of the holdings are all about, if we put our clients' cash in, tell us about when it's coming out and how substantial it's coming out and how certain it's coming out. And that's absolutely the conversation we have again and again. Of course, you've got to overlay it with risk. That's related to how well you look after your customers. Tell us about how well you look after your customers. Tell us about how it's changed. Tell us how it was last year, how it is compared to your competitors. And then how well do you lead your staff? You've got to have a motivated staff to deliver good customer service. Again, these are questions which aren't really covered by most presentations with PLCs. It's a completely different conversation compared with many other ways of investing. But most particularly, hopefully, the downside risk in permanent loss capital isn't there. We've got safe balance sheets usually. So hopefully there's not much time before they actually start to produce. If they don't hit their early targets, they'll still hit targets later this year.
Okay, and just on the sort of like sort of your current portfolio, what is your sort of your sweet? Is it active? You sort of like try and take a reasonably sizable position in a small cap to be able to sort of influence management, or is it sort of like, do you are an active manager rather than a sort of like a passive tracker, for instance, or is it really just the stock picking side?
I mean, stock picking is very much part of it, but dilution of risk is best we can. Buy companies with safe balance sheets, make sure that they don't run out of money so they don't have to put the emergency funding in. Make sure you've got potential upside. We get some wrong, we have to take losses at times, but make sure you keep weeding that portfolio so you've always got good things coming through. And most particularly, if you actually, have a diversification, the small cap fund, often has 80 or 100 holdings in it. The multi-cap income fund has had 120, sometimes 140 holdings. So it's not about actually getting the rifle shot and being lucky with a massive winner. It's absolutely having a number of holdings which can give you an evergreen type portfolio, which is very important to us.
Okay, and then just sort of like on your portfolios, the sort of the large cap and small cap, are there any stocks that you would say investors might well be interested in sort of having a closer look at that you think are sort of well positioned, undervalued? I mean, you look at some of the beaten down sectors. I mean, if you contrast it with the growth, a lot of growth stocks, the software as a service trade on maybe 10 times sales. But having said that, you've got a lot of beaten down, even technology stocks in the small cap sector that are still relatively, very, very relatively cheap. And also you've got sectors like financials, and I know energy's very out of favour and stuff like that. But there must be opportunities in those areas that are certainly worth having a closer look at.
Yeah, I mean, generally you're looking for companies which are, working hard to generate that cash payback. So you might see a step change perhaps in internet demand. So a recent purchase in the portfolios has been AO.com, which is the company which obviously delivers appliances online. Outstanding customer service, very overlooked. It got to a market cap of 1.6 billion after issue. Was as low as about 300 million recently. It's actually moved up quite considerably. That's near a billion again. But a billion, sales of 1.2, 1.4 billion, that kind of size. And in Amazon, which is obviously a very major company and a very successful company, stands at about between 5 and 6 times sales. And I think AO.com is just as good as Amazon in its own market. In fact, you might argue it's even better because it delivers stuff to things. So there's an example. Financials, I think, are very overlooked. So you might see company opportunities, maybe Provident Financial or perhaps Secure Trust, which is a bank. Again, companies which are really well positioned in terms of balance sheet with cash paybacks as that management, those management teams deliver value going forward. Again, some of these financials with the bond yields backing up could start to produce very good returns as well.
Yeah, and I think that probably the dividends on some of the mainstream banks should be, hopefully coming through if we do get a solution with a vaccine or even the testing side next year, and maybe some of the insurers as well, sort of like start reintroducing in dividends there, and so that looks, I agree, totally looks very interesting. What's the sort of like decision process when it comes to selling stocks? How do you sort of like when you compare price and value? If a stock is, say, I don't know, 25 or 50% overvalued that your value when you come to value it, what triggers your sort of like process to have a look at to sort of like to sell it or to trim it or to rebalance your portfolio?
Certainly when holdings become large, as Avacta did, it's not that it's overvalued, it's just that we've taken some profits because it's a big part of our portfolio. So minimizing risk is part of the issue. But most particularly, the main things which are driving it are, we really look for cash payback, and you need sales growth to get cash payback. If sales decline is a red light, it is probably a hell. If you get margins, even if you've got sales growth going forward, if you've got margin pressure, you can't get your cash payback. It is a sell. If you gear up hard, we used to hold Conviviality, for example. The reason we sold it wasn't because we had any knowledge that they'd mucked up with the acquisition. It's just that they geared up their balance sheet, and that was a red light for us, and so we sold it. So the three disciplines principally are sales peaking out, margin pressure, balance sheet risk. Of course, valuation as well. When things become very highly valued, very happy, other people can have it. We'll buy something overlooked. Would you mind?
Have you got any sort of like advice for investors who are sort of like, because when you go into the small cap space, sometimes, unfortunately, with a lot of idiosyncratic risks because they're, small companies, etc. You can go through a fallow period, and I've been through it in my career, and I guess you probably have as well. And I know some of the portfolios,
exactly. I'll tell you all about it.
Exactly, some unfair criticism. How do you actually manage to, one, control your emotions, and also two, sort of like get through those difficult periods without doing something crazy when, so many people are perhaps, sort of like you're beating yourself up that there's certain things go wrong, but frankly, it's just a bit of bad luck in the grand scale of things of a much longer journey. How do you control those emotions? How do you to make sure that you don't do anything, sort of like suboptimal?
Well, I mean, the main thing is actually just talking to the companies. We're incredibly lucky that we get such good access to companies. I think with Zoom and all the other things, I think we're getting more access to companies even than before. Probably Martin, Turner, and myself probably meet more companies than most other teams in the market, maybe more than any other team, I don't know. So we just do vast numbers of meetings with companies. And actually, that's just such a motivating factor. Meeting, world-leading companies doing the right thing, often in a little garret somewhere where they just haven't had the fair reflection of their, opportunities, means the risk-reward ratio just gets tremendously exciting. Now, last year, as share prices were going down, it may have looked that the stocks were the wrong ones. They just weren't. It's just that people weren't giving them a fair hearing. And so every time you talk to the company, you think, my goodness, the risk-reward ratio on this is just beautiful. And that is so reassuring. So just keep an eye on the nature of the risk-reward ratio, and don't worry too much about the share price. Often the share price is the kind of finishing post, but a lot of people regard it as a kind of score chart. And if they haven't got a good share price, then they're not successful. No, stuff all that, right? Look at the fundamentals. If you've got cash in with gazillions of cash coming out in the next 18 months or 2 years, help yourself. Don't feel too embarrassed by it.
Yeah, no, I mean, I totally agree. I mean, I've been through those periods, and I find one of the indicators, which is exactly the same as you, if you value the shares and you put a fair value on it, concentrate on the fair value, not the price. The price is just a day-to-day. And if it gets a bigger gap, then it's more attractive, no doubt about it. Just in sort of like data or sort of areas that potentially can flag what the economy is doing. I mean, you talk to sort of like, 60, 70, 80 companies on a sort of constant basis over year. Does that give you the sort of the grassroots insight into what's happening in the economy? Or do you actually look at some macro indicators? I don't know, maybe the BBB sort of corporate debt. How do you get a feel of where we're heading in terms of the economy and the stock market?
Yeah, you're absolutely right. I mean, I speak to a lot more 70 companies a year. I speak to hundreds and hundreds, actually. But often these are customers or suppliers of many of our companies, perhaps competitors. So it gives you quite a good insight and having insight to that. But really, because we invest in small quoted companies, obviously we need to think about the investment weather ahead. And that's about minimizing risk. And so we do, look at what is happening in terms of the macroeconomy. We do have strong views. I've written books on the subject. So I've got a very strong mental model I'm working, which is that the world's going to change. Globalization was a sensational period, but it's coming to an end. We're putting grit in the machine in the form of tariffs and trade barriers and stopping dealing with Huawei and all the rest of it. Those cost producers aren't getting access to the market they were. And this is actually meaning that overall market momentum could slow down considerably. And that actually we may not just get, markets rising in the way they used to. So going forward, you've got to find individual stocks which are going to buck that trend.
Yeah. And how do you sort of, do you take any sort of protection at all, as in like with risk? Do you use derivatives or put options or anything to manage the portfolio? Or is it basically just a straight equity and you use time as your sort of like a hedging mechanism?
Yeah, we very rarely use put options, basically because the stock market doesn't crash very much. So most of the time you put a put option on and it doesn't deliver any value. We only do it when actually towards the end of bull markets when the price of a put option is subnormal. So you're actually spending a lot less money. And of course, the risks are slightly higher. So we have had a put option in our multi-cap income, our diverse income trust for a few years. Last year, actually, we put it into the small cap funds as well. It was it's an exceptional moment. We felt that the risk reward ratio was coming even nearer the end. We didn't know about COVID, but we thought something would upset it. And so we actually had put options only for part of the portfolio, out of the money, albeit coming into the crisis. And the great advantage of that isn't just that you protect assets on the way down. but actually you cash it in March, you bring in 5, 6, 7, 8% extra cash, and you can buy extra holdings at depressed prices, so you have more portfolio on the way up. You actually enhance the return for investors through the cycle. And that's a wonderful thing to be able to do just occasionally, but we normally don't do it, to be honest, because most of the time the markets don't crash.
Yeah. And have you got any sort of final tips at all for investors to sort of generate alpha rather than sort of straight beta? If there was anything that you'd sort of like say people should remember in terms of when looking at companies or stocks and stuff, to sifting through AIM, which is a lot of stuff that perhaps you don't want to invest in, but there's real gems in there. There may be sort of 200-300 that you really want to have a look at. Is there anything that you would sort of like give advice to investors to sort of like concentrate on?
Well, one thing I really would say is drop your preconceived ideas. I mean, when I meet companies, I have no screening mechanism at all. Anyone who rings me up, if I've got time in the diary, I will do a meeting. And the great advantage of that means that actually quite a lot of the companies, I think, well, it's probably not done very well, and it's got this problem and that problem. And often that's right, but just occasionally it's completely wrong. And my preconception is what's in the share price. And when I meet the company, they say, by the way, actually, that's not quite right, and we're doing a lot better here, and the market's changed over there. And suddenly you get this mismatch between the share price, which has got all those preconceptions built in, and the potential. And that is a wonderful opportunity at that moment to make an abnormal return, hopefully, if things are right.
Okay, thanks very much, Gervais, and very thanks for the sort of the excellent insights. If any investor would like to sort of like put some money into the funds, where is it best contacted? Is it through the website or through you direct, or how could investors sort of contact you or the company?
Yeah, I mean, just go on to the website. We have quite a lot of sort of, interviews with myself, some fact sheets, which are good. We do quite a lot of effort into the annual reports for the diverse income and the Microcap trust. So if you'd like to have those, do let us know. We're very happy. But look before you leap. Don't just jump in. Absolutely take your time over these kind of decisions. Yeah.
Well, I would say, again, a big congrats on this year. To be number one in your in the hit parade on the unit trust and in the smaller cap, and number two in the smaller unit trust. I mean, I don't think anybody's ever done that. So that's a bit like the Beatles doing 3 number ones. So really well done. I think you've probably whetted investors' appetite going forward, and you probably raised your own bar rather high. But anyway, best of luck, and thanks very much, Gervais.
Thank you very much for the opportunity.